Bitcoin at $1 million is that crazy talk. Or, an inevitable future we should all be preparing for.
It does sound pretty out there, doesn't it? Almost like science fiction.
Exactly. But, you've shared some really fascinating sources with us, and this idea, it's not just wishful thinking from random internet forums anymore.
Not at all. It's being seriously discussed, modeled even, by some pretty significant players.
Right. So today, on the deep dive, we're going to really unpack those, bold predictions. We'll meticulously examine the underlying drivers that could actually propel Bitcoin to that, seemingly impossible $1 million mark.
Yeah, looking beyond just the hype.
We're sifting through the latest research, the on-chain data, real-world economic stuff, basically trying to give you the clearest, most comprehensive picture possible of what's really going on here.
It's absolutely necessary. I mean, the idea itself, Bitcoin at $1 million, it's staggering. If that happened, it would fundamentally redefine everything, its value, its role in global finance, maybe even our whole concept of money.
Yeah.
And what's really fascinating is the huge range of opinions. You've got the true believers, often deep in the crypto space, who see it as like almost a mathematical certainty based on economics and tech adoption.
The HO dealers.
Right. And then on the complete other side, you have, the staunch skeptics, usually from traditional finance, just dismissing it as pure speculation. A bubble.
Just waiting to pop.
Exactly. So our mission today is to cut through that noise, really explore the most compelling arguments, look at the evidence behind this extraordinary claim, and just help you understand this incredibly complex, fast-moving landscape of factors that could potentially make it a reality.
Okay, sounds good. Let's unpack this by starting with some of the big names, the people putting these really ambitious numbers out there. First up, someone instantly recognizable in disruptive innovation and investment. Cathie Wood and ARK Invest.
Ah, yes, ARK. Their research is widely respected, very data-driven.
And they boldly predicted Bitcoin could realistically hit $1 million, specifically by 2030.
That's their time frame, yeah.
So what's their core rationale? I mean, why such a huge number?
Well, it really boils down to two incredibly powerful forces they believe will converge. First, accelerating institutional adoption, big money coming in.
Okay.
And second, Bitcoin's inherent unchangeable scarcity. The fact that there's only ever going to be 21 million.
Right. Scarcity plus demand. Basic economics, almost.
In a way, yes, but amplified massively. They're not just talking about the price going up. They're forecasting a fundamental re-rating of Bitcoin, seeing it become a legitimate, essential, and increasingly significant asset class on the global stage.
So more than just digital gold, maybe. Part of the standard institutional playbook.
That's the idea. What's really crucial to understand about ARK is their methodology. They don't just, pull numbers out of thin air. Their models often use things like Monte Carlo simulations.
Okay, sophisticated stuff.
Very. They project scenarios where various traditional asset classes, think sovereign debt, corporate cash, those huge institutional portfolios, even bits of the gold market, start allocating just a small percentage to Bitcoin.
And even a tiny slice of those markets is huge money.
Astronomical. Think about pension funds, sovereign wealth funds, they manage trillions. If they just reallocate, say, 1% or 2% of their portfolios to Bitcoin, the sheer volume of capital flowing in would be immense.
Wow.
So ARK's thesis sees Bitcoin basically absorbing a significant chunk of traditional financial market value. Why? Because of its unique properties as a store of value, a hedge against inflation.
And that fixed supply of 21 million coins becomes its superpower in that scenario.
Exactly. It can't be inflated away like fiat currency. That makes it incredibly valuable as an alternative to assets that can be debased by governments or central banks just printing more money.
So it's not just price up, it's a whole reconceptualization of Bitcoin's role in a diversified global investment strategy.
Precisely. A fundamental shift in how big money views and uses.
Okay, that's ARK Invest. Then we have another really influential figure, Balaji Srinivasan, former CTO of Coinbase, well-known VC. Very different perspective, maybe.
Yeah, Balaji definitely comes at it from a different angle. He made huge headlines back in 2023 with that very public prediction. He bet $1 million of his own cash that Bitcoin would hit $1 million within just 90 days.
90 days. That was incredibly bold.
Mm.
And, well, it didn't happen.
No, it didn't. And he readily admits the timing was incorrect. That short-term surge just didn't materialize. But, and this is the really interesting part, why his prediction is still so relevant even though the timeline was off.
The underlying message.
Exactly. His underlying message was incredibly powerful, almost, you could say, prophetic in its macroeconomic focus. He wasn't just gambling on market trends.
He was worried about something bigger.
He was ringing alarm bells
Mm-hmm.
loudly about impending hyperinflation fears. He argued that central banks' unprecedented money printing, massive government spending it, would inevitably debase fiat currencies. He saw Bitcoin as the ultimate escape hatch.
Like a lifeboat.
A necessary response, he argued, to what he saw as an inevitable currency collapse, or at least significant debasement.
So his bet, even though wrong on the time frame, was really a warning shot.
You could see it that way. A potent, if maybe a bit dramatic, thought experiment. It forced a global conversation about these extreme economic scenarios that, let's be honest, many in traditional finance might prefer to sweep under the rug.
Yeah, nobody likes talking about hyperinflation.
Not really, but Balage's focus wasn't on, short-term chart patterns or retail sentiment. He zoomed way out, looked at the structural weaknesses of traditional fiat currencies in this environment of QE, huge national debts, soaring money supply globally.
And how does that connect to Bitcoin specifically?
Well, his perspective aligns perfectly with and really amplifies that digital gold narrative we hear so much about.
Okay.
He positions Bitcoin as a superior store of value, something unconfiscatable, inherently deflationary, that simply cannot be debased by central bank policies. Unlike traditional currencies, which are subject to political whims, unlimited printing.
Right, the 21 million cap again.
Precisely. He basically presented a worst-case macro scenario where Bitcoin becomes the default safe haven, the logical place for capital to flee when a monetary system starts crumbling.
That's a powerful argument. So even if his 90-day timeline was way off, the question remains.
Are the fundamental macroeconomic concerns he highlighted still valid drivers for long-term Bitcoin appreciation? Many people, especially those worried about government spending and currency debasement, would say absolutely yes, maybe even more so now than in 2023.
Makes sense. Okay, so we have these bold predictions from people like Cathie Wood and Balaji coming from slightly different angles. Let's really dig into the core pillars now, the arguments supporting this $1 million thesis. The first one seems pretty foundational, right? The Bitcoin scarcity and those halving cycles.
Absolutely. This is arguably the most fundamental, the most unique driver. Anyone familiar with Bitcoin knows the basics. Fixed supply. Only 21 million coins will ever exist, full stop.
Period. And that's just fundamentally different from traditional money.
Completely different. Central banks around the world can and definitely do print unlimited amounts of their currencies. That leads directly to inflation, your money buying less over time.
Bitcoin doesn't have that problem.
By design. That fixed supply isn't just a feature, it's the bedrock of its design, its appeal as a hard asset. It's a direct philosophical counterpoint to fiat currencies that can be inflated away.
But it's not just the 21 million cap, is it? There's this other mechanism, the halving.
Exactly. Beyond that absolute cap, Bitcoin has this truly ingenious mechanism, the halving. It happens roughly every 4 years. It's programmed right into the code.
And what does it do?
It cuts the reward miners receive for validating new blocks, for adding transactions to the blockchain, in half. So, for example, after the most recent halving in April 2024, the reward dropped from 6.25 Bitcoin per block down to 3.125 Bitcoin.
So less new Bitcoin is created with each block.
Precisely. It systematically, dramatically shrinks the rate of new supply entering the market. Every 4 years, boom, the flow of new coins is slashed, making new Bitcoin increasingly scarce. It's like a built-in supply shock.
A predictable supply shock.
Yeah.
And historically, what happens after these halvings? The sources we looked at really emphasize this pattern.
The historical precedent is compelling, to say the least. After every single halving event since Bitcoin started, 2012, 2016, 2020, its all-time high price tends to triple, or often much more, in the following 12 to 18 months.
Wow. Every single time.
So far, yes. It's like the market has to absorb this predictable reduction in new supply, and historically, the price adjusts upwards significantly afterwards.
Could you give us an analogy? How should we think about that?
Sure. Imagine owning, say, a rare piece of art, part of a limited edition print series. The total number of prints is capped forever. But then imagine every 4 years, the number of new prints being released from the artist's vault onto the market gets cut in half.
Okay, so fewer and fewer new ones become available.
Exactly. Over time, that original artwork becomes incredibly rare in circulation. Demand keeps growing, maybe, but the already dwindling rate of new supply gets even smaller. It just drives up the perceived value, the actual value, because it's harder to get. Creates undeniable upward pressure.
That really clarifies the supply-side shock. It's built in.
It is. And this predictable scarcity model is exactly what the stock-to-flow model tries to quantify.
Ah, stock-to-flow. I've heard a lot about that. Plan B, right?
That's the one, pioneered by the pseudonymous analyst Plan B. It gained a lot of traction for projecting Bitcoin's scarcity curve. And its trajectory, according to the model, points towards, or even beyond, $1 million by the late 2020s.
So what is it actually modeling? Stock versus flow.
Essentially, yes. It tries to model the relationship between the existing supply of an asset, the stock, how much is already out there, and the rate at which new supply is being produced, the flow. For Bitcoin, after each halving, the flow of new coins gets cut in half, while the stock keeps growing but slower. So the stock-to-flow ratio, the existing amount divided by the new production rate, increases dramatically. A higher ratio suggests higher implied value due to increasing scarcity.
Like gold or diamonds, which have high stock-to-flow ratios.
Exactly. Assets that are hard to produce more of relative to what already exists tend to be good stores of value. Now, it's really important to say the model isn't perfect.
What are the criticisms?
Well, critics argue it might be overly reliant on past performance, that it doesn't fully account for demand-side shocks like a sudden drop in interest, or maybe that the effect diminishes as Bitcoin's market cap gets bigger and bigger.
Okay, so not a crystal ball.
Definitely not. But it provides a powerful quantitative way to think about the impact of Bitcoin's programmed, increasing scarcity on its potential long-term value. It highlights that core feature.
Makes sense. So scarcity is pillar one, driven by the fixed supply and the halvings. But scarcity alone doesn't guarantee value, right? You need demand.
Absolutely. Supply is only half the equation.
Which brings us neatly to driver number two, the huge surge we've seen in institutional adoption. This feels like a really big shift recently.
Monumental. It's arguably the most significant shift in Bitcoin's perception, maybe ever. Bitcoin has moved from being this, fringe thing for tech geeks and retail gamblers.
Right. Used to be seen as kind of niche, even shady by some.
Exactly. To now being a legitimate, recognized asset class for major financial players globally. We're not just talking about individual investors anymore. We mean the big institutions, pension funds, hedge funds, wealth managers, even corporations putting it on their balance sheets.
The smart money.
That's the narrative.
Yeah.
And perhaps the biggest catalyst for this recently was the approval and launch of the spot Bitcoin ETFs in the US in early 2024. That was a game changer.
Yeah, that felt like it was years in the making. Huge news.
It really was. You now have giants like BlackRock, Fidelity, ARK Invest themselves, Grayscale. These are titans of traditional finance, managing trillions, offering these products.
And what do these ETFs actually do for adoption?
They make it incredibly simple for mainstream investors to get exposure. Think financial advisors managing retirement accounts, or even large institutions. They can now buy Bitcoin exposure right through their regular brokerage account. No need to worry about setting up a crypto wallet, security, private keys, self-custody, all that stuff. That was a barrier for many.
So it just lowers the friction massively.
Instantly, it opened the floodgates to a huge pool of capital that was previously sitting on the sidelines, maybe interested, but held back by regulatory worries or just the operational hassle.
And the impact. Have we seen the money flow in?
Undeniably.
Yeah.
The sources we looked at show these ETFs collectively fueled tens of billions of dollars in net inflows, just within a few months of launching.
Tens of billions, wow.
Yeah. And if you look at the charts plotting ETF inflows against the Bitcoin price, the correlation is striking.
You can see it directly.
A direct, powerful relationship. As money flowed into the ETFs, the price accelerated. It means institutional money is now a significant, undeniable, and easily trackable demand driver. It's not just talk anymore. It's real, verifiable capital coming in through regulated channels. That's a profound shift in market dynamics compared to previous cycles.
The scale is just different now.
Completely different. The amount of capital these institutions represent dwarfs what retail investors alone could bring.
And it's not just ETFs, right? You mentioned corporations, too.
That's right. Beyond the ETFs, we've seen this growing trend of public companies adding Bitcoin to their balance sheets, treating it as a treasury reserve asset like cash or gold.
MicroStrategy is the big example here, isn't it?
They're the poster child. Led by Michael Saylor, they started aggressively accumulating Bitcoin back in 2020. Now they hold over 200,000 BTC.
That's a lot of Bitcoin.
It's a huge amount. Their conviction is so strong, they've even taken on debt specifically to buy more Bitcoin. It's fascinating. Their stock, MSTR, now often trades almost like a leveraged Bitcoin play.
Meaning people buy MicroStrategy stock partly just to get Bitcoin exposure.
Exactly. It reflects this deep corporate commitment to Bitcoin as a strategic, long-term investment. Their fortunes are now heavily tied to Bitcoin's price.
And Tesla dipped their toes in too, right? Elon Musk.
They did. Their initial purchase in early 2021 was a massive signal to the market. Even though Musk later made some controversial comments about energy use and they sold some of their holdings,
Yeah, that caused a stir.
it did. But that initial move by Tesla, such a high-profile, innovative company, putting Bitcoin on its balance sheet and briefly accepting it for payments, that fundamentally validated Bitcoin for so many other companies and investors.
It opened the door for others to consider it.
Absolutely. Even if their stance shifted later, that initial corporate adoption by a global brand like Tesla spurred countless discussions in boardrooms worldwide. It laid important groundwork for broader corporate interests down the line.
So what are the bigger implications of all this institutional comfort and money coming in? How does it change the game?
It fundamentally changes the market dynamic. With more sophisticated, long-term oriented players entering, it could potentially reduce Bitcoin's infamous volatility.
Really? Make it less wild.
Potentially. Not eliminate it, probably, but maybe dampen the extreme swings. Institutions tend to have longer investment horizons. They're less likely to panic sell during dips compared to maybe some retail investors. Their participation could foster more long-term holding, stabilizing demand.
It brings legitimacy.
A huge amount of legitimacy, plus depth and stability that were largely missing in Bitcoin's earlier, more retail-driven days. It shifts the perception from, a niche speculative gamble towards a strategic, increasingly accepted part of global finance. That transformation is absolutely key if you're talking about unlocking the kind of capital needed to reach targets like $1 million.
Okay, that makes a lot of sense. Institutional adoption is clearly a massive force. Let's shift gears a bit to driver number 3, global inflation and currency debasement. This feels very relevant right now.
Hugely relevant, especially given the, tumultuous economic landscape we've all lived through in the past few years. We've seen central banks globally just pumping out money, quantitative easing, stimulus checks, basically creating vast sums of new currency out of thin air.
Injecting liquidity, they call it.
Right. Injecting liquidity, increasing the money supply, and the direct result, inflation. Your cash buys less and less. It's a direct erosion of the purchasing power of traditional fiat currencies.
And this is where Bitcoin comes in as a potential solution.
This is precisely where Bitcoin's core value proposition really shines. As a potential hedge against exactly those inflationary pressures, the contrast is just so stark.
How so?
You have Bitcoin, absolutely fixed supply, 21 million coins, auditable on the blockchain to not be arbitrarily increased, versus fiat currencies, unlimited printing capacity, controlled by central banks whose decisions are often influenced by short-term politics or economic goals, not necessarily long-term monetary health.
So when governments print more money,
Each existing dollar or euro or yen inherently buys less. That's debasement. Bitcoin, just by its design, is immune to that specific type of debasement. Its digital scarcity becomes incredibly appealing. For many, it feels like a necessary safeguard in a world where financial instability, huge national debts, currency depreciation, these are growing worries everywhere, developed and developing countries alike.
it's almost like opting out of that system.
For some, yes. And this idea, this protection against debasement, it's even led a whole country to embrace Bitcoin. El Salvador.
Right. Their move was huge news. Adopting Bitcoin as legal tender back in 2021 still seems pretty radical.
It was groundbreaking, and yes, still controversial, but think about it. This wasn't just a company adding it to their balance sheet. This was a sovereign nation saying, this digital asset, Bitcoin, is now officially our money, alongside the US dollar they were already using. A monumental, real-world experiment.
A huge signal. What was the thinking there? Why would a country do that?
It's often described as the Bitcoin experiment. It frames Bitcoin as potentially viable sovereign money, especially relevant, perhaps, for smaller nations dealing with unstable local currencies or very high cost for sending money home from abroad remittances, or for countries heavily reliant on the US dollar, which itself isn't immune to inflation.
So multiple motivations.
Definitely. Seeking more monetary independence, trying to attract foreign investment from the global Bitcoin community, and also providing their citizens, many of whom don't have traditional bank accounts, with a more resilient, accessible financial alternative.
And the long-term implications. if this catches on?
Well, the long-term implications for global finance could be substantial, especially in emerging economies looking for ways to escape fiat volatility or dependence on a single foreign currency like the dollar. If more nations follow El Salvador's lead, even just by adding Bitcoin to their national reserves, it could signal a really significant, though maybe slow, shift in the global monetary order. It challenges the status quo.
It really does. Which leads us perfectly into driver number 4. This powerful digital gold narrative. It's not a new comparison,
Right.
but it seems to be getting stronger, more detailed.
It really is. People are directly comparing Bitcoin's core properties to traditional gold, humanity's longest standing store of value. And the comparison holds up surprisingly well in many ways.
Like what? What are the key parallels?
Well, think about why gold works. It's scarce, it's durable, it's relatively divisible. People trust it holds value. Bitcoin shares many of those properties. It's provably scarce, incredibly durable on the blockchain, highly divisible.
More divisible than gold, actually.
Much more divisible, yeah. And importantly, it's censorship resistant, hard for governments to seize or block transactions. Plus, it has advantages gold doesn't.
Such as?
Portability, mainly. Think about it. You can send billions of dollars worth of Bitcoin across the globe in minutes for a relatively small fee. Try doing that with physical gold bars.
Right, you need armored trucks, security. It's cumbersome.
Exactly. Bitcoin is also easier to verify. You can check the blockchain yourself. In a world that's increasingly digital, mobile, globally connected, a physical asset like gold, needing secure vaults and complex logistics for large transfers, starts to look a bit, well, analog. Less efficient than its digital counterpart for many use cases.
So the argument is Bitcoin is like gold 2.0,
Right.
suited for the digital age.
That's at the core of the narrative. And if that narrative holds, the potential upside is enormous. Gold's total market cap is estimated somewhere around, what, $13 trillion? Maybe more now.
Yeah, a huge number.
So the premise is simple. If Bitcoin manages to capture even a fraction of that market cap, as capital maybe rotates from gold to digital gold,
Then $1 million Bitcoin price isn't so crazy.
mathematically it becomes highly probable. Yes, imagine Bitcoin's current market cap. It's significant, but still tiny compared to gold or global stocks or real estate. Bitcoin is still a small fish in a giant ocean of global assets.
So massive room to grow if it eats into those other markets.
Exactly. That market cap comparisons chart people often show is a really vivid way to see this. If Bitcoin reached, say, just 25% of gold's current market cap, the price per coin would be well into the hundreds of thousands, maybe approaching that $1 million mark.
And this isn't just speculation. It's about changing preferences.
It reflects a potential major shift in investor psychology. In this digital, globalized, inflation-prone world, maybe investors will rationally prefer a digital store of value, one that offers better transaction features, easier storage, undeniable scarcity compared to a physical commodity.
Moving from physical value to digitally verified value.
Right. The digital gold narrative isn't just hype. It's about a fundamental rethink of what makes a reliable, liquid, accessible store of wealth in the 21st century, recognizing the advantages of digital native assets in an increasingly digital world.
Okay, that's a compelling case. Now, all this adoption, all this value, it relies on the network itself being strong and secure.
Right. Absolute critical.
Yeah.
You can't build a trillion-dollar asset on shaky foundations.
Which brings us to driver number 5. The network effect and the security that comes from Bitcoin's hash rate.
Yes, these two are deeply intertwined and incredibly important. The network effect is a well-understood concept. The more people use a network, the more valuable it becomes for everyone.
Like telephones or the internet itself.
Exactly. Metcalfe's law often describes it, the value is proportional to the square of the users. For Bitcoin, this isn't just individual users buying coins, it's the whole ecosystem. More exchanges offering liquidity, more financial products being built on top, more developers working on scaling solutions like the Lightning Network, more merchants accepting it, more infrastructure supporting it.
So each new participant adds value disproportionately.
Right, creating this powerful, self-reinforcing loop. More users attract more developers, which creates more utility, which attracts more users, and so on. And crucially, this growth also directly boosts Bitcoin security through its hash rate.
Explain hash rate again, what that measure.
Hash rate is basically the total combined computational power that miners worldwide are dedicating to securing the Bitcoin network. They use this power to solve complex cryptographic puzzles, which validates transactions and adds new blocks to the chain.
And why is a higher hash rate better?
because the higher the hash rate, the more computationally difficult, expensive, and just resource intensive it becomes for any single entity or group to gain control of more than 50% of the network power. That's what's needed to potentially launch an attack, like reversing transactions or double spending coins. So higher hash rate equals higher security, greater resilience against attack. It's a direct measure of the network's integrity.
So as more people get involved, more institutions invest in mining.
The hash rate generally trends upwards, making the network exponentially more secure, more resilient.
And that increased security builds more trust.
Exactly. It builds more confidence among potential users, institutions, everyone, which then attracts even more participants, further strengthening the network effect, maybe encouraging more mining investment, pushing the hash rate even higher. It's that powerful reinforcing loop again.
And are we seeing evidence of this, like in the data?
Yes, definitely. Leading on-chain analytics platforms like Glassnode, for example, show really compelling data. One key metric is Bitcoin supply held on exchanges.
What does that tell us?
It generally shows a consistent long-term decline in the amount of Bitcoin being held on centralized exchanges where it can be easily sold.
Meaning people are moving it off exchanges.
Right. It suggests that large holders, the so-called whales, are accumulating Bitcoin, perhaps at lower prices during dips, and then moving it into secure, cold storage, offline wallets they control directly.
Which implies they're not planning to sell anytime soon.
Exactly. It signals a very strong conviction-based long-term belief in the network's future value and its continued appreciation they're holding for the long haul.
That's a powerful indicator of sentiment.
It really is. That declining supply on exchanges is often seen as a bullish signal, potentially a precursor to price increases, because it means a less liquid supply is available to meet new demand.
Less supply available to buy.
Right. And other on-chain metrics often paint a similar picture. Things like long-term holder supply hitting new highs, meaning more coins are held by addresses that haven't moved them in a long time. Or metrics like the MBRV Z-score, indicating when Bitcoin might be undervalued, often correlating with accumulation phases by smart money.
So the data suggests maturing supply dynamics.
Yeah, it points towards that. You have this combination, growing network utility, incredibly robust security through that ever-increasing hash rate, which, by the way, is also becoming more geographically diverse and increasingly powered by renewable energy sources.
That's an important point on the energy debate.
It is. And add to that the deep conviction we see from these large, often sophisticated long-term holders. It paints a picture of a digital asset moving beyond just speculative hype. It's maturing into a deeply entrenched, arguably increasingly indispensable part of the financial system for many.
Okay, so we've laid out a pretty strong case covering scarcity, institutional adoption, the macro environment, digital gold, network effects, quite a few powerful drivers pointing towards potential massive growth.
It's definitely a compelling set of arguments.
But as we always do in our deep dives, we need that balanced view. $1 million Bitcoin isn't a foregone conclusion. There are significant hurdles, real challenges, counterpoints we absolutely have to consider.
Absolutely. No serious analysis can ignore the risks.
So let's start with maybe the elephant in the room for many. Regulatory risk. This seems like a constant cloud hanging over crypto.
It absolutely is. Regulatory uncertainty remains a major and very dynamic hurdle. In key economies, the US, the EU, globally really, there are ongoing debates and concerns about how Bitcoin and the wider crypto market will be classified, taxed, overseen.
And unclear rules are bad for business, bad for adoption.
Definitely.
Yeah.
Unclear, inconsistent, or worse, overly restrictive regulations could significantly dampen that institutional adoption we just talked about. It could slow down retail adoption too, and consequently hinder price growth.
Like the ongoing SEC battles in the US.
Exactly. Those legal fights between the U.S. Securities and Exchange Commission and various crypto companies create a lot of uncertainty. Who's a security? Who's a commodity? What are the rules? Similarly, while the EU has its MiCA regulation aiming for clarity, how it's actually implemented and interpreted across different countries still poses potential challenges.
So what could bad regulation actually do?
Well, imagine governments imposing really strict capital controls on crypto, or classifying Bitcoin in a way that makes it super difficult for regulated institutions like banks or pension funds to hold or transact with it, or imposing punitive taxes. Any of those could definitely throw cold water on the bullish thesis.
It's such a tricky balance, though, isn't it? Because some regulation could actually be good.
That's the paradox. On one hand, Clear, sensible rules could bring much-needed legitimacy and safety. It could make traditional finance players much more comfortable entering the space. It could protect consumers from scams and bad actors. That could actually accelerate adoption.
But the flip side.
The flip side is the risk of heavy-handed or poorly designed regulation. Rules that inadvertently stifle the very things that make Bitcoin appealing: its decentralization, its permissionless innovation, its global accessibility. You could end up killing the golden goose, so to speak.
So the urgent need is for clarity, but the right kind of clarity.
Exactly. Clarity that fosters innovation while ensuring market integrity. That's the tightrope regulators need to walk. It raises this fascinating question. How will governments navigate this? How do they maintain control or oversight in a world with increasingly decentralized financial tools?
Yeah, that's a huge question.
And it's vital to remain impartial here. Thoughtful regulation can absolutely reduce illicit use, protect consumers, provide clear operating rules for businesses. Those are good things for market maturity. But the risk of overreach is always there. Regulations could unintentionally undermine Bitcoin's core principles or just create huge barriers to entry.
Can Bitcoin thrive under heavy regulation, or does it compromise its nature?
That's the billion-dollar or maybe trillion-dollar question. Can its decentralized spirit survive integration into the traditional regulated financial world? The path forward really depends on regulators finding that pragmatic sweet spot, supporting innovation without crushing the fundamental characteristics that give Bitcoin its value.
Okay, regulation is clearly a major hurdle. What's another big challenge that often comes up?
The energy debate. Bitcoin mining's energy consumption. This gets a lot of attention, especially from an ESG perspective: environmental, social, and governance investing.
Right. The argument that Bitcoin mining uses too much electricity harms the environment.
Precisely. Bitcoin's proof-of-work consensus mechanism, by design, requires significant computational power, which consumes a lot of electricity. Critics often highlight the carbon footprint, especially if miners are using electricity generated from fossil fuels. This leads to pushback from some investors, policymakers, environmental groups.
Is that criticism fair, or is it more complex?
It's definitely complex and often, frankly, misunderstood or oversimplified. Yes, it uses energy, but it's crucial to look at the evolving energy mix. There are very strong arguments and real demonstrable efforts pushing the industry towards renewable energy.
Like miners seeking out specific energy sources.
Exactly. Miners are actively seeking out stranded energy excess power from hydro dams, solar farms, wind farms that might otherwise be wasted or curtailed because the grid can't use it at that moment. They're also increasingly using flare gas from oil drilling sites, gas that would otherwise just be burned off, releasing methane, which is a potent greenhouse gas. Using it to mine Bitcoin is arguably better than just flaring it.
So turning waste into value, essentially.
That's the argument. Plus, many major mining companies are publicly committing to carbon neutrality, investing in efficiency, developing better hardware. The debate is absolutely ongoing, and it remains a factor for ESG-conscious investors. It affects public perception. But the industry is innovating rapidly towards a greener footprint. Addressing these concerns transparently and continuing to adopt sustainable practices is really crucial for wider acceptance.
Okay, good context there. What about competition? Could something else replace Bitcoin? Maybe those central bank digital currencies, CBDCs, that governments are working on.
CBDCs are definitely a form of potential competition, yes, though their nature is fundamentally different from Bitcoin.
How so?
CBDCs are basically digital versions of a country's existing fiat currency, issued and completely controlled by the central bank. They offer digital convenience, sure, but they retain all the centralized control, the potential for surveillance, the programmability that traditional fiat has. They are the opposite of Bitcoin's decentralized, permissionless, immutable ethos.
So they don't offer the same features people like about Bitcoin.
Not at all. But they could potentially reduce the perceived need for a private, decentralized digital currency among some people, especially those who prioritize convenience and trust government-backed systems. It's an alternative digital payment rail.
And what about other cryptocurrencies? Ethereum, Solana, these next-gen blockchains. Could they overtake Bitcoin?
That's another angle of competition. These other blockchains often aim to improve on Bitcoin's perceived limitations, maybe faster transaction speeds, more complex smart contract capabilities, better scalability for things like DeFi or NFTs.
So they might be better for certain jobs.
They might gain significant traction for specific use cases, absolutely. Ethereum is the dominant platform for smart contracts and DeFi. Solana is known for speed and low fees. But crucially, none of them has yet matched Bitcoin's sheer network effect, its unparalleled security derived from that massive hash rate, or its global recognition and adoption specifically as digital gold, a decentralized, truly scarce store of value.
So they might coexist rather than replace.
That's the dominant view currently. It raises an important question for you as an investor. Can these competitors truly kick Bitcoin out of its digital gold niche? Or do they serve different, perhaps complementary roles in the wider crypto ecosystem? Most seasoned observers think Bitcoin's specific role as that base layer, neutral store of value is pretty secure, largely unassailable by these other chains focusing on different functionalities.
Okay. And one last major challenge, maybe the most visceral for individual investors, market volatility
Yeah.
and just retail patience.
Ah, yes, the roller coaster.
Yeah.
Bitcoin is notorious for it. Wild price swings, exhilarating on the way up, absolutely brutal on the way down.
Stomach churning is a good word for it.
It really is. And the big question is, does the average retail investor who maybe has less capital to risk, a shorter time horizon than a big institution, have the emotional strength, the sheer patience to ride out those massive drawdowns? We're talking potential drops of 70%, 80% from all-time highs. These happen.
And are often necessary for the long-term climb, paradoxically.
Often, yes. Clears out leverage, resets sentiment. But can people HODL through that? We see these cycles constantly. FOMO, fear of missing out, driving irrational buying near the peaks, followed by paralyzing FUD fear, uncertainty, and doubt that shakes out even people who believed in the fundamentals when the price crashes.
Selling low, buying high. The classic mistake.
Exactly. So volatility is Bitcoin's historical constant. Every investor just has to accept it, plan for it. Institutions might have the deep pockets and the truly long-term outlook to handle it. But retail investors often react emotionally, driven by biases like loss aversion, hating losses more than enjoying equivalent gains.
So the road to $1 million won't be smooth.
Almost certainly not. It will likely involve multiple deep corrections, long periods where the price goes sideways or down. This just highlights how much psychology plays a role in investing in assets like this.
So what's the takeaway for individuals?
Understanding the why. Understanding those fundamental drivers we talked about. Maintaining conviction in the long-term thesis if you have that conviction after doing your research. That's paramount to avoid getting swept up in the emotional FOMO-FUD cycles that lead to bad decisions. It requires discipline. Things like dollar-cost averaging buying regularly, regardless of price, or moving coins to cold storage to resist the urge to panic sell.
Discipline and conviction. Easier said than done during a crash.
Much easier said than done.
Okay, so we've covered the drivers, the challenges. Quite a journey. Let's zoom out now. Why does this whole $1 million Bitcoin discussion even matter? What are the real-world implications if it were to happen? Not just for crypto nerds, but for different people, different markets.
Yeah.
Let's start with investors, especially the long-term believers, the HO dealers.
Okay. For long-term holders, a $1 million Bitcoin changes everything. It fundamentally alters their portfolio strategy, their entire financial future. For people who got in early or who just consistently stacked sats through thick and thin.
Dollar cost averaging.
Right, it represents potentially unprecedented wealth creation, truly winning big in a way that could be generational. It elevates Bitcoin from just being a speculative punt to potentially a core foundational part of a diversified portfolio, maybe even the primary component of someone's net worth. It could mean financial independence for many.
Life-changing money, potentially.
Potentially, yes. This scenario forces investors to think really deeply about their own goals, their investment horizon, risk tolerance, maybe even legacy planning. What does winning big actually mean for your financial future? How would it impact your retirement, your ability to support your family, maybe philanthropic goals? It shifts the conversation from just making returns to defining what wealth means in this new digital era.
That's a profound shift for investors. What about traders? The ones playing the short-term game. Is $1 million relevant to them?
It is, but in a very different way. While long-term investors are focused on that distant peak, Bitcoin's volatility, the very thing that scares HO dealers sometimes, is what creates constant opportunities for short-term traders. Even on a theoretical path to $1 million, the journey will be full of ups and downs.
So volatility is their friend.
Exactly. For traders, volatility isn't a bug, it's the essential feature they profit from. Those sharp, often dramatic price swings, both up and down, provide endless opportunities for sophisticated strategies. Scalping tiny profits, day trading, swing trading over days or weeks, even using complex algorithms.
It requires a totally different skill set.
Completely different. It's intense focus on technical charts, precise entries and exits, managing risk very carefully, understanding leverage, making rapid decisions in fast-moving markets. The long-term trend might be up, but the short term offers this constant churn, potential profit and loss in both directions. It really highlights the speculative side and how crucial a solid trading plan and discipline are. High stakes.
Makes sense. And zooming out even further, what about the whole Web3 ecosystem? If Bitcoin hits $1, what happens to altcoins, NFTs, DeFi, the whole digital economy?
The ripple effect. A $1 million Bitcoin would likely inject, just flood, an immense, unprecedented amount of liquidity and attention into the entire Web3 space.
Why is that? How does Bitcoin affect everything else?
Bitcoin often acts like the sun in the crypto solar system. It's the gravitational center, the main entry point for new capital, the ultimate risk-on, risk-off indicator for the whole market. When Bitcoin pumps hard, it tends to pull everything else up with it. Altcoins, NFTs, DeFi protocols often follow suit, sometimes with even higher percentage gains. It's often called Bitcoin dominance, decreasing as money flows down into riskier assets.
The rising tide lifts all boats idea.
Precisely. This massive influx of capital from a $1 member Bitcoin would likely fuel a huge new wave of innovation across the board, accelerate development in DeFi, GameFi, NFTs, metaverse projects. It would likely lower barriers to entry for new Web3 startups, attract even more venture capital funding, pull more talented developers and entrepreneurs into the space.
So it could push Web3 towards mainstream adoption faster?
Significantly faster, potentially. We could see much quicker integration of blockchain technology into traditional industries. It really could be the catalyst that shifts Web3 from being a relatively niche interest to becoming a much more pervasive part of our digital lives, integrated into the global economy in ways we're only just starting to imagine.
Wow. Okay, so the implications are massive across the board. We have truly unpacked a lot today. From those audacious predictions by ARK and Balaji to the core drivers like scarcity and institutional adoption, and also the very real challenges like regulation and volatility. It's definitely complex.
It really is. Hopefully, though, you listening have a much clearer understanding now of all the different forces at play.
Yeah, absolutely. And now, as we wrap up, we want to leave you with some food for thought, some questions to just mull over after this deep dive finishes. Based on everything we've discussed, what really stands out to you?
Indeed. As you process all this, maybe consider these questions. Do you personally believe Bitcoin can hit $1 million? And if you do, what's the single most compelling driver for you? Or, conversely, what's the biggest risk that makes you hesitate?
And here's a practical one. If Bitcoin does hit $1 million someday, what's your plan? Are you a HODL forever type, or do you have an exit strategy, a price target, a phased approach? It's a really important thing to think about before it happens, not during the excitement or panic.
That's crucial planning. And thinking about the how, do you see institutions as the main force driving BTC towards that $1 million mark? Or will it be more about continued grassroots retail adoption, maybe more countries like El Salvador getting involved? What's the primary engine in your view?
And finally, a really personal gut check question. What price target, or maybe what specific market conditions or news would make you stop accumulating Bitcoin? At what point would you feel you have enough, or that the risk-reward is shifted, and maybe start taking some profits or de-risking? It forces you to really define your own conviction and your own financial goals.
Those are great questions to ponder. Ultimately, this deep dive has shown, I hope, the powerful forces pushing Bitcoin forward, that undeniable scarcity, the halving clock ticking, the accelerating institutional embrace, its potential role as a hedge in uncertain times. But also the significant hurdles regulation being perhaps the biggest wild card. Understanding these intertwined dynamics, the push and pull, is just crucial for anyone trying to navigate this space, regardless of whether you personally think $1 million is likely or just a fantasy.
Couldn't agree more. The journey itself is fascinating, regardless of the destination. It's about this fundamental reevaluation of money, of value, of financial power in our increasingly digital world.
Well said.
And hey, if you found this breakdown useful, if you enjoyed this deep dive into the road to a potential $1 million Bitcoin, and you want to see more content that really digs into the details like this, do us a quick favor. It really helps us out.
Yeah, it makes a big difference.
Please take a second to like this deep dive, subscribe to the Deep Dive channel if you're not already, and definitely hit that notification bell so you don't miss the next one. Your engagement, the likes, the subscribes, the comments, even, it genuinely helps support the channel. It boosts our visibility in the algorithms, tells platforms people find this valuable.
And most importantly, it lets us keep doing this researching, analyzing, and creating this kind of in-depth crypto content for you.
Exactly. We really appreciate your support. It lets us keep the lights on and keep digging, more than you know.
Because at the end of the day, knowledge is power, especially in markets as fast-moving and, let's face it, volatile as crypto. Being informed is your best asset.
Couldn't have said it better myself. Until next time, keep digging deeper into the information that truly matters.